perhaps the most exhilarating experience of my life professionally, and the whole feeling of creating something new, something completely radical, and something that completely changed the paradigm of how investors interacted with the stock market was an extremely rewarding experience. And I think to some extent, this picture to me says it all. The reason it was so much fun, the reason it was so exciting, was that it facilitated the democratization of access to the market. I still remember 20 years ago, after the launch of ICICI Direct, I was in Hyderabad and I wanted to meet some of our clients. And of course, my team wanted to introduce me to the large clients, and I said, no, I want to meet a small client. And when I met this gentleman, he spoke only broken English, but what he said to me was, thanks to online trading, I am no longer dependent on my broker to pick up my phone call, and particularly on a volatile day when he has large investors to satisfy, he never picks up my call. But the online system is there, and it's always available to me on any day at any point in time. I think that was the first day that I truly understood the power of technology and the power of fintech and its ability to facilitate financial inclusion. So to me, the entire industry is really exciting, and not only exciting but exhilarating, for this reason and this reason alone, that it's going to completely transform the landscape of financial services with the entire ability to bring the cost of delivery so low that, in effect, businesses can afford financial inclusion. It is not something that has to be mandated to them. It just happens because it makes the business so much more viable. So this is why I love the fintech world. Where do I need to point to get this done? There? Yeah. And of course, my faith in the entire startup ecosystem. I think there is no discussion now, no debate, that India is really rocking. And that's thanks to the entire startup ecosystem, whether it is the entrepreneurs, or whether it is the funding mechanism, or whether it is the entire infrastructure now which facilitates this kind of innovation. In this drive for innovation, which is at the core of the fintech world, I want to share some basic thoughts with you. Most entrepreneurs, when they go for funding, they are asked the question, what problem are you trying to solve? What is the need that you are trying to fulfill? And indeed, that is the starting point. Sometimes this need is an articulated need of the consumer or the investor. Sometimes it's a latent need. The consumer doesn't even know he needs it. But when it is presented to him, he suddenly realizes how powerful it is, and then you have adoption that follows and the wonderful hockey stick effect that we've seen in many of the businesses. So at the core, there is the question of fulfilling the need, the unmet need of the consumer. However, with my regulator hat on, here's what I would like to say. In meeting that need, by construct, since it is new, since it is innovative, the chances are that there will be a regulatory gap in terms of governing or regulating that product or that service or whatever it is that is meeting that need of the consumer. It's almost by construct. If it is new, it has probably not even entered the heads of the regulator, let alone be captured in the regulation. And the reason for that is that in our country, our regulation is a hybrid regulation of principle-based and rule-based. If the regulation was merely principle-based, then every conceivable situation would get covered under it, and in many ways there would be no regulatory gap. But since we have a hybrid system in our country, with a fair amount of emphasis in our judicial system on the rules part of the regulation, it is natural and expected that there is likely to be a regulatory gap when there is something new and innovative that happens in the market. Now, it's up to the regulator to keep pace with that. In the past, we've been a little late to the party. It is our intention now to narrow that gap as much as possible. But that gap, as I said, structurally will continue to exist, and therefore the question arises that what does the ecosystem, the startup ecosystem, do about it? How do you think about it? And there I think that both the entrepreneurs as well as the people who are funding these entrepreneurs could be well advised to think about the principles that guide a regulator. So while there is no extant regulation on a particular subject, if you think about what are the key principles that a regulator will follow when they finally show up and regulate it, you are already ahead of the curve. You're anticipating what the regulator will say and do, and if you're already baking that into your business model, then it's a check, 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 and you will not have business model disruption when the regulator finally shows up. So to share some of these principles the way that SEBI looks at it, I'll begin with the question of anonymity. A lot has been said about the crypto world, and going forward, the technology will facilitate, the central bank's digital currency will facilitate a certain ecosystem for tokens, for cryptos. It will happen in due course. The question is, as you are thinking about it, you need to understand that while on social media, it's quite all right. I can go on social media and call myself, I don't know, Sunflower 500. It's okay. But in the fintech world, when it comes to financial services, anonymity is not something that the regulator is ever going to permit. So if you start your business model on an assumption of anonymity, and if that is a key selling proposition in your business model for your consumer, it's not going to last. When the regulator shows up, and probably now sooner than later, it will not be okay, and then you'll have a problem of saying, oh my God, this was the regulatory risk, but you know that to begin with. So anonymity in the financial world is an absolute no-no, and that's the first guiding principle in your checklist, whether you're an entrepreneur or a private equity funding entity. The second is around transparency. So this is really about the whole concept of saying that a regulator's principal job is to ensure in the markets that investors make informed decisions. Nobody argues with that. The question is, for an investor to make an informed decision, he must have information. Without information, how will he make an informed decision? And therefore, the issue of transparency is key. If the regulator senses that there is inadequate disclosure, then the question is the investor being misled? This is a little bit more aggressive form of the same issue. Is the investor being conned? So again, if your business model is woven around a black box, okay, and a lot has been said about, in the markets now, I know there are many people working on algos. A lot has been said about, is SEBI in favor of these algos, against these algos? SEBI is not in favor of or against anything. provided there is transparency, disclosure, and nothing which is misleading. So if somebody is claiming that their algorithm is delivering 350% return, first of all, I'd really love to meet these guys, because I'm wondering, why are you telling the whole world about it, right? Even Warren Buffett doesn't deliver these kind of returns. You should just be making all of this money on your own. But if you are claiming, here's what SEBI does about it. SEBI engages with these people and says, okay, and this is not a futuristic thing. This is actually what has happened over the last many months. SEBI says, okay, you are claiming 350% return. Okay, very good. How do you arrive at this number? Someone says, we do simulation. Okay, very good, sounds good. So let's recreate the simulation. What is your input data? Must be market data. Okay, our exchanges are here, they have all the market data, here's the data. Now let's run your algo and simulate it for the last 1 year. You got it? Answer was no. I'm saying no, but you just said that's what you do. That's just what you said. That's how you arrived at 350%. So let's simulate it again. You simulated it yesterday. Let's simulate it here with SEBI and the exchanges watching the simulation. No. So what does the regulator want? Regulator says, let there be an independent assessment of the claims that you are making to the investor, so that nobody can blame you. In fact, it is for the protection of both the investor and the offerer of the service. Nobody can blame you that you are conning the investor, because here is somebody, the exchange is right here, they have all the data. They are now going to validate your simulations and say, yes, this is really a fantastic algo, it really delivers 350%. Okay. Then of course we are quietly told, no, it's 350% under certain market conditions. Now, are you being conned, right? So if your business model is going to rely on a black box which is not open to sunlight for disinfecting, if it is not capable of being validated and audited, and your claims cannot be audited and validated, it cannot be permitted. But if it can be audited, can be validated, nobody is happier than us to facilitate new and innovative offerings in the market. So this is the second checkbox. One was anonymous, the other is validation of your claims. If you're unable to validate, your business model is under threat, because when the regulator shows up, this will not be acceptable. The third is back to my favorite slide. When it comes to financial inclusion, most regulators in our country have very, very supportive regulation. Okay? So for instance, let's say SEBI itself, in the mutual fund industry, up to 50,000 rupees, cash transaction is permitted. Up to a certain limit, PAN number is not required. You just need something called a PECRIN number. So when it comes to financial inclusion, the whole objective of the regulator is aligned with you. So if you are operating at the bottom of the pyramid, truly operating at the bottom of the pyramid, it's not just a nice tag to have, and you can demonstrate that these are the kinds of limits that you have in terms of your offerings, the regulator is more than delighted to be supportive and to make it easier, simply because that is an important part of our agenda always. So this is the third checklist. If your business model facilitates financial inclusion, then to that extent that you have those citizens within your fold, the regulator is bound to be very supportive. It will be a sustainable business model. This is one of the key requirements of every regulator. I refer to it as the Abhimanyu complex. If you have a business model which relies on the assumption that once the customer is in, it's very hard for him to get out, we don't like it. So building barriers to exit, again, if your business model relies on that, it is unlikely to find favor with the regulator. It's a very important principle that we follow. And therefore, as I said, when the regulator shows up, you will be vulnerable to regulatory risk, because the regulator will say a person who has ease of entering has a right for ease of exit. If you make it hard for him to leave, we will not permit you to make it easy for him to come in. We do not want Abhimanyus in our market. So this is an important checklist. Check in your list. Please ensure that your business model does not rely upon कि वो एक बार आ गया बकरा तो उसको हम पकड़ के रखेंगे, बाहर नहीं जाने दें. This is again a very, very crucial piece, and I think most of you here are very familiar with the concept, but let me articulate it as a principle. In our country, very different from almost every country in the world, we not only have a stated objective, but we have an implemented evidence that the infrastructure for innovation will be a public good. Whether it is Aadhaar, whether it is UPI, whether it is account aggregator, whether it is the health stack, whether it is anything. The rails will be a public good. Private innovation needs to build on top of those rails. If somebody again has a business model where their presumption is that they are going to own the infrastructure, you're setting yourself up for a rude shock subsequently. It's good, it's ambitious to say we want to be the infrastructure, but as you have seen in our country, that's not the path that India takes. The Reserve Bank of India has demonstrated it so beautifully through these various mechanisms. SEBI on its part, given the way that we look at the market infrastructure institutions, given the way we look at data. So why in this conference was our emphasis on data, and we requested the organizers to organize this data-thon? Because for markets, the markets thrive on data. And we have ensured by actually issuing a circular that every piece of data which is there in the markets on account of something that the regulator has said must be disclosed has to be available free of cost and in a machine readable format and in an easily downloadable format and cannot be charged for. So as an example, we had a very lively conversation with some of our exchanges where the discussion was, well, if the investor wants the data, we are happy to give it free, but if a service provider, let's say an investment advisor or one of the new Fintechs want that same data, we will charge for it. I'm like, okay, be my guest. So from tomorrow, SEBI will issue a circular saying that all data, instead of being uploaded on the exchanges, will be uploaded on SEBI website and we will offer it free. अब आपको जो करना है आपकी मर्जी. So what is it we are saying? For us, data is a public good. It is public infrastructure. No private person can claim ownership over this infrastructure. We ensure that it is made publicly available in any form or manner. You want a feed, you want this, you want API Connect, everything is free. Nobody can charge you for it. If they do, please let me know. Please send a mail at chairperson@sebi.gov.in. So this is the path that the regulators in India are taking. So again, on your checklist, claim that you will own the public, the infrastructure. It's very unlikely. By the time we show up, we will not permit it. This is a somewhat difficult principle to articulate. I call it structural vulnerability. So, as you know, all the regulators, financial regulators in the country, we meet often on issues of financial stability. And we discuss not specific cases, but we discuss structural vulnerabilities, concentration risk, technology risk, governance risk. And these issues are really manifested. Let me give you an example to illustrate. So say for instance, in recent times, SEBI has come up with a whole host of regulations to facilitate direct movement of funds and securities between the investor and where it needs to go, whether the exchange or whether, in the case of an IPO, to the issuer. What is the objective here? The objective is, if the money or the securities pass through many hands, there is a structural vulnerability at each stage. And because we don't want to curtail and put huge requirements of net worth and so on, let's say, on the broking system, we say, no, we only want very large brokers, so, minimum net worth of 1,000 crores. Okay, then there'll only be a handful of brokers, but that's not what we believe in. We believe in competition. So, the attempt is you eliminate the possibility of wrongdoing through technology and through process re-engineering. And we have done that systematically, those of you who are aware, for instance, in terms of posting collateral with the clearing corporation, it's now done through a pledge-repledge system of shares, instead of the shares actually moving and passing through different hands. So it stays in your account, pledge is created, then a repledge in favor of the clearing corporation is created. The shares never move. Similarly, you know that we have ASBA for the IPOs. So in that, the money never moves from your account. If you get an allotment in the IPO, that much money is taken. If you don't get an allotment, nothing is taken. We are now actively engaged in looking at ASBA like the secondary market. So if it can be done for the primary market, why can it not be done for the secondary market? So again, if you are buying shares and you have to settle, the money should never leave your account. When it needs to be settled on T+1, because as you know, we're rapidly moving towards T+1, the money will be appropriately taken. So the attempt is to reduce structural vulnerability. Again, therefore, if your business model is such that it will increase concentration risk or structural vulnerability, chances are sooner or later the regulator will move to eliminate it. So this, in summary, are the set of principles that should guide every entrepreneur in the fintech space and everybody who is funding, because when the regulator comes up for regulation, to bridge that regulatory gap that you are seeing today, these are the kind of principles that they will follow. Having said that, given the pace, that one's not mine, it doesn't matter. It's good to think anyway. So the issue really is that today, as we stand here in India, we are well aware that we are setting the pace globally. And that is what makes us really proud. And I can assure you that as a regulator, when we meet people from overseas, the pride we take in sharing what the market participants are doing and what is the level of innovation that is happening in the country, it is something that's indeed a matter of great, great pride for us. So with that, I conclude and happy to hand over in respect of the data talk. Thank you.